20 seconds now to the ECB's interest rate decision. The ECB saying purchases are intended to continue at a monthly pace of 60 billion until the end of December 2017 or beyond, if necessary, and in any case until the Governing Council sees a sustained adjustment in the path. Looking at the markets here, the German bonds sell off sharply in the wake of these ECB comments. The euro has gained ground against the dollar. It's up around 50 ticks on the day.
When it comes to the ECB, the main area where you can make some money is in the press conference. This is where they will announce new measures. This is where they will explain their decisions. So a bit of statement science is what's important if you're looking at trading the ECB. Now, the clues all come from language, and they do have a propensity to actually give you a clue if you're willing to look into the language. History is important. This all started off with the previous head of the ECB, Jean-Claude Trichet. Now, he had quite a rigid way of using language to explain any kind of moves in interest rates. He used the words strong vigilance. Whenever he said strong vigilance, this meant that next month they will hike rates. We saw this in November 2005. He said they've left rates on hold, but at the same time, strong vigilance with regard to upside price stability is warranted. This meant they were going to hike in December. So the move comes on the November meeting, not in December. By December, we all know where rates are going to go. What he would then do is he would still maintain that they are in a hiking cycle. So in January, they will continue to monitor very closely. This means that they're not going to do anything at the next meeting. However, they are willing to. So if the opportunity is there, then they will. At the next meeting, of course, you then get, against this background, we will exercise vigilance. So, you know, immediately in Feb 2006, rates are going higher in March 2006. And this proceeded for quite a few months, and we saw the interest rates gradually tick up 0.25% at a time. Now, Mario Draghi, when he came in, was a little bit more subtle with his ideas and his way of saying things. What he started to use, really from November, mid-November, he started to talk about preparation of further measures. And this was tasking the ECB staff with ensuring that they've got the measures in place. You didn't necessarily know what they were going to do, but it was sort of stating that they're winding up to do something. And he continually started using the ideas or words to the effect of reassess, analysis or analyse, review and preparatory work. If he just mentioned preparatory work, this meant that the next meeting we could see some indication of what they're looking to do. We saw this in the run-up to the beginning of QE, and this happened December 2014 in particular. We'd already had preparation of further measures in the November. In December, he came out and said, in this context, early next year, we will reassess monetary policy. So you know that next year they're going to do something. He does state early next year rather than an actual month. And should it become necessary to further address prolonged risks, the ECB remains unanimous in its commitment to use unconventional instruments. This also became a phrase, unconventional instruments, within its mandate. So it was saying that they may have a little bit more. And then he finally put in, this would imply altering. So it's been very clear here that they're likely to do something at the next meeting. And once again, talks about preparations, but they have stepped them up. So you're getting all the clues that something is coming in the January meeting. What it is, we don't know, but we know there's something coming. So roll on to January. What happens? He delivers the action. Now, the trade opportunity here was knowing about the December meeting. He said that they were going to reassess next year. You didn't get an exact knowledge of when, but the idea was that it could possibly be January. As soon as he said, we conducted a thorough reassessment, as soon as you heard conducted, you knew that they completed whatever they wanted to do, and so you knew that something was coming. He then goes on to list what exactly they did, and the main thing was expanding the assets purchase program. This is your QE. So that began, or it didn't begin in the January, but he told us it was going to start. He told us when, he told us the amount. He also added some other stipulations, and this was all released in a statement a little bit later, just giving you a clue as to what they could buy. 2 to 30-year bonds, anything up to 25% of the bonds issued by a country. So they were sort of giving themselves limitations on what they could buy, which, remember this because that will come in later, it means that they can only buy a certain amount of bonds. Also, they can't go below the deposit rate. So that again is also very key, the fact they can't go below the deposit rate. Once bonds start dropping below it, they're ineligible for the ECB to buy. And they're also spread according to the capital key. Capital key is a sort of weighting of all the nations within the EU based around their GDP, the size of their bond markets. I'm not sure that anyone actually knows the specifics of how it's worked out, but there is a weighting of each country. So that's what we got. We got the delivery of the action. Now, I mentioned the trade was on conducted. As soon as he said that, and at least once you got as far as thorough reassessment, you knew something was coming. So let's have a look at how the markets reacted to this. This was the DAX. This spike here is the 12.45 interest rate announcement. Now, we got no move in the rates, but you got a statement saying there will be a statement on the press conference. So we got a big spike up, drop back down. This caught out everyone just buying the immediate jump up, thinking the statement was going to tell you what they were getting. They all got squeezed out. We got a big drop. This was very, very similar to what happened in July 2014. So if you do want to look back at the charts, go and have a quick look at that. And so you saw this spike both ways, and then we continued higher into the press conference. Now, once the press conference started, the word conducted came in right about there. So that was your opportunity. You could buy the DAX, you're buying right around 103.76, and you can see we got up to 104.59 within, this is a 1 minute chart, so that is a 1 minute move of nearly 100 ticks in the DAX. So very big move. Once again, though, we did see this big reversal. This is quite common when you get big announcements from the ECB, that you see a quick reversal, people get squeezed, they all drop back out, and then we range on for the rest of the day. Bond market's a little bit less so on the reversal. You do still get it, but a little bit less so. This was the Bund, and once again, you got a very small dip at the beginning of the press conference, perhaps because the equities are starting to move higher, so you get this risk-off play. You then get the big buy-up on the announcement of QE, and then you get the continuation for the rest of the day. Ultimately, they are going to be buying bonds, and Germany being the biggest weighting in the capital key, as well as the biggest bond market in Europe, is going to get the brunt of the buying. So clearly the Bunds is the place to be, and they do rally a long, long way. We rally about 2 points over the course of the press conference. In fact, well, yeah, over the course of the press conference, really, 2 point move in the Bund. Right, so following the introduction of QE, we know what their tagline is now. We know that it is going to be something along the lines of reassessment reviews. So when we get to October, Mario Draghi comes out and starts the press conference with a little bit of a downbeat view. He starts talking about growth prospects for emerging markets and how this could have negative or signal downside risks to the outlook for growth and inflation. Immediately now you're thinking, right, he's getting a little bit downbeat. Is there a possibility that they're going to announce something new? The market is wondering about this. So it's semi in the expectations, but not a particularly strong idea of it. Downbeat view makes you think that this could be possible. That's a very early and very aggressive entry for a trade, but there is good risk reward on it. It's unlikely that they're going to step back from QE or anything like that. They've already, in the September meeting, upped the issuer limit to 33%. So you know that they're still progressing with these ideas. Good risk reward trade there to take on a long in equities on those comments with the expectation that they may well do something. So he then comes in and talks about inflation close but below, but close to 2% in the medium term, and this will require thorough analysis. There you have it. There's the tagline back. So we know now that they are likely to be doing something at the next meeting. As he then goes on to say, monetary policy will be re-examined at the December meeting. So he's being very specific now. We know exactly when it's coming. It's coming in December. And then he also talks about the size, sufficient flexibility in terms of adjusting size and composition. So we now know come December, he's going to do something. He's at least going to do a reanalysis, and we're expecting some kind of new measures. So this is what the markets did in reaction to that. Again, straight off the bat, we know what this means now in the equities. So you do get this straight off bid up in the DAX. Again, the press conference, I do recall trading this. When he started talking about emerging market weakness, the DAX had already got up to around about these highs. If you then bought it after that on the thorough analysis comment, we still got a good winner, but the early entrants started to get out as we moved up towards 103.73. That's what caused the sell back down. But everyone knows now that they will produce something in December. Now, once you've got the move going as well, the opportunities do keep coming. The moves do slow down in terms of their pace, but we do get this continual grinding trend. And this is something you do quite often see in the DAX. So slightly away from central banks here, but you do often see this, whereby you get the first move in the DAX, a secondary move up, and then it becomes a little bit harder to position yourself. What you've got to do is be very, very patient. Rather than trying to buy breakouts, you need to be looking for retracements, and you get it here very nicely, 103.68, just a small push through 103.73. Anyone trading the DAX will know that a 5-tick squeeze through is fine. And in fact, if you look at these little lows here, they are around about 103.73. So that little dip down to 68 was actually a squeeze on those longs. And once again, you see it at 104.27, you get another chance of a long. So you are getting the opportunity to get back in. You've just got to apply a little bit more patience. But that is what we see. We see a continual move now. Everyone knows what the pattern is. So that's why you're seeing the continual putting on of more and more longs in the expectation of something in the December meeting. Now, keep in mind these prices. We're trading around the 10,373, 10,500 area in the DAX. So keep that in the back of your head for the next couple of slides. Likewise, I'll just show you the euro and what we did there. Very quick drop in the euro, very strong drop. And this again, just continued lower, and we continued to drift off. The market really took this to mean something, and they took it to mean that there was going to be a further extension of QE. Not only that, in the euro, the Fed had also signalled that they could well raise rates in December. So double whammy for the euro dollar, that you're going to see selling on dollar strength as well as euro weakness as more QE is expected. So this is the December meeting. We've all expected it. Markets are really pricing in something from the ECB. Now, what this means, and this is where structure comes into play, you need to be thinking about what they could possibly do to really get the markets moving on this now, as the expectation is for definitely some kind of adjustment to policy, probably more QE. So he starts off in time-honoured fashion. He's already signalled it, so he starts off with "they have conducted." That's your first chance to buy. However, the market will hold off now. Reason being, because it is so well priced in, there's no need to buy it. Everyone's already long in the DAX. They're already short in the euro. And what happens is he doesn't deliver enough. They only deliver an extension. The extension is to March 2017, so they will keep buying at the same pace until March 2017. And that is all we get. So what do you get? This is what we see. The euro has trended down. This was the October ECB meeting, up on the left, as well as the Fed possibly signalling a rate hike. We then get this very slow trade coming down, and you get this wedge built in the euro. What this is indicating is it's running out of move. You know, it's come off a long, long way. It's come off 10 points since the October meeting. And really, what more can they do to actually send this any lower? This is where structure is so important. You get the dip down at the beginning of the meeting on the expectation of something, or the last people having a go at that trade. However, you very quickly get the turn. And this is the, excuse me, the point with structure, that because of the way it's come down, there are a lot of stops on these highs, and these highs that are all likely to go. Ultimately, none of these have really been tested. It was very easy to hold a short from the last ECB if you were a little bit more long term. And we got this massive rip higher as all those shorts got out and more people bought it to take advantage of that. Again, we saw the opposite in the DAX. Now, as I said, remember, we were trading around the 10,300 to 500 area. By this meeting, the DAX was right the way up at 11,200, so we've gone a full 10 points in the DAX, and we saw this turned around very, very quickly. So we got a little bit of a skip up here on the, the fast early little punt that they're going to do something, and obviously they would have had to do a lot to get the DAX really going any higher. Didn't see it, and you got this very, very aggressive sell-off. The DAX actually dropped 300 ticks in 3 minutes on that ECB. So probably one of the biggest moves you'll see on a central bank, one of the biggest moves you'll see in the markets. And this is the point. This is why central banks are so important, why it's so important to be ready for them and have your trades prepared. Be aware of the structure. So that was the December meeting of the ECB. You've probably got the gist of where we're going with this now. But after that December meeting and the big shakeout in markets, the ECB clearly decided that they had not done enough and they did need to do more. This is where they are somewhat influenced by the markets. Now again, coming into this meeting, he starts off this time with yet, as we start the year, downside risks have increased. You immediately think to yourself, right, there is a chance here that they're going to do something. They under-delivered massively. So is there a possibility? This again is one of those lower risk trades that they're unlikely to reverse what they last did. So if they don't feel that they've done enough, are they going to do more? And once again, you see the standard review and possibly reconsider. Here we go. Once again, we know what's coming. They're going to do something in March. And this is what we see in September. In January, I do apologise. You see a bit of a shakeout to start with in the DAX as they're unsure if they're going to do anything, and they talk about downside risks, and this is where you get that small bit of selling to start with. But as I say, decent risk reward on that trade to have a go at buying it, and you do get the rip higher once again in the equities. But once again, they do turn around. This seems to be very typical of the equity markets. You get a very fast ramp and then they turn. With the bunds, you do get the strong ramp up. They hold on to the gains, but do notice the first time we looked at this, when they first said they were going to do something, we got a 2-point move in the bunds. What you've got here is 75 ticks. So clearly much more muted now. We all know what's coming, and the question is really, what more are they going to do? So what we did get the surprise with is the next meeting. Not necessarily that they did something, but the surprise in how they delivered it. Previously, as you've seen, they would always give it in the statement, in the press conference, and they would explain what the action is and explain how they're going to do it. March 2016, it all came out differently. At 12:45, you got all of the information. So they told you that they're cutting rates. They told you that they were going to add corporate bonds to the asset purchases, and that the asset purchase program will be increased to 80 billion euros. So you've got all of these elements, but what you did see at the very beginning is ECB took policy action at this meeting. That was the first line that came down, and the market started to move straight off it. And then you got the corporate bonds, the additional purchasing from the ECB. So that was your clue. That was the big difference. And so immediately you've now got to bank that information. Upcoming meetings, you're going to get all the info at 12:45, and then any additional will come in the press conference a little bit later. Now we know the patterns of how the ECB goes about doing things. This is how we prepared for that December ECB meeting. We got in September and October that he had tasked relevant committees to evaluate options. And again, in October, options to ensure smooth implementation of the purchase programme until March 2017. Now, the worry is, come December 2016, the ECB has only got one more meeting after that before their bond purchase scheme ends, just totally ends. And that means all of a sudden, from buying 80 billion euros a month, come March 17, that will just be gone. All of that buying in the market, totally gone. And the market is very scared of this. This happened with the taper tantrum, as it was called in the US, whereby the possibility of them reducing their QE purchases really scared the markets and got the markets really moving around. So this is something the ECB is very aware of, but also something the markets are very aware that they need to do something, and December was then looking like the likely opportunity to do it. He also stated that they will benefit from new staff macroeconomic projections. So there we go. We're thinking, right, he's got to do something to prolong the purchasing program, or at least explain what they're going to do next. So coming into the meeting, what you need to do is you've got to assess what the expectation is. They don't expect any change in rates. The key expectations are that 80 billion will be extended. So they're going to extend it from March 2017 up until Sep 2017. And that really is the expectation. That is about all that we're expecting. There are then possibilities, because the fear is that the ECB is running out of bonds to buy. Reason for this, you have had bond yields in the very short end, particularly of the German curve, they have dropped significantly. So bond yields on 2-year German are currently at about 0.75% minus, which means they don't qualify. The ECB cannot buy them. The reason they're getting bought up is because of tightness in the repo market. Now, you remember we spoke about repos. Banks will need high-quality collateral to sell in order to get more money, to get more funding. So they're buying up short-end shats at negative yields so that they can use them in repo operations. So this is a worry for the ECB, that they are running out of bonds to buy. So what are their possibilities? Possible things they can do is drop the capital key. This is politically difficult. There are a lot of rules around the capital key and the ratio that they can purchase bonds, so that is quite a difficult thing for them to do. Nonetheless, that's not what the point of this is. You shouldn't be considering what policies they can and can't do. You should be considering what you're going to do if they do it. Now, drop of the capital key means that they can buy more bonds from other countries. At the moment, the predominant bonds that they're buying are German. So as soon as they drop the capital key, you're going to see flows move out of Germany and into some of the more higher yielding bonds, because they're going to be backed by the ECB effectively, meaning your default chance is very low, but also they're offering you a better yield. So the trade here would be to buy BTP and sell Bund. So there you go, there's your one trade. And this is what you've got to just have focused in your head. Whatever trades you're going to do, know exactly what you're going to do and execute that trade. If they don't drop the capital key, then that trade is done. Don't do it, don't even consider it. They can drop the deposit floor. What this means is they can buy below the minus 0.4% deposit rate, and therefore all of these 2 years are purchasable by the ECB. What this is going to do is give a big lift into the shats. So if they drop the deposit floor, the trade is buy shats. Again, they can increase the issuer limit. Should they do this, it's a little bit of a less solid trade. Ultimately, they will not be able to buy shats because they're still going to be below the depot floor. So the trade is going to be to buy bunds. But as I say, this is quite a limited aspect of something they can do and wouldn't last all that long. So ultimately, this buy could be short-lived, meaning you need to be in and out very quick, take your money, and don't expect such a big move. What you also need to do is factor in the size of the move that you're going to expect on something, on whatever these moves are. Now, the next thing they can do is reduce purchases. This would effectively be seen as a taper. Now, immediately, the first thing you're thinking there is sell bunds. Also, sell equities, sell stocks, and buy euro. Reason being, they're taking stimulus away, negatively impacts stocks, will definitely negatively impact the bund because that's what they've been buying, and also it is a buy for the euro because effectively that means that rates are rising, making the euro more attractive. They could do nothing, absolutely nothing at all. Now, if they don't extend the purchases, this is going to be very bad news. There's going to be big worries on what they're going to do and big fears that this could be a complete taper, or not even a taper, just an end to QE. So this is the big one. This is sell stocks. That's what you go for first. Reason being, all the stimulus has gone. Stocks react very well to stimulus or no stimulus. So they are the most binary thing on these kind of occasions. So it would be sell stocks and then sell bonds, because all of the buying's gone, irrespective of what bond market it is, all the buying will have gone. So it would be sell bonds generally in Europe. Now, the next thing they could do is extend the purchases. And ultimately, this is going to come down to how many months they do it for. If they do it for an indefinite amount of time, that is going to be a big buy. and that again will be in bonds and stocks. And that will be a big sell for the euro. So you've got your trades, you know exactly what you're going to do. If it's none of these, then there's no trade. You sit back. If they do exactly this, the 80 billion for 6 months, then you do nothing. You sit back and you wait. You wait and see if there's anything in the press conference that you can trade. But if any of these come out, you've got to react. You've got to know exactly what you're going to do, and you've got to do it very, very quickly, because everyone else is thinking about these things as well. Everyone else will react to it. Everyone else will jump in on it. So that's where you've got to be ready for, and that's how you execute trades. So what do we get? This is the announcement. As we said, because of the March 2016, you know you're looking out for the 1245. Have your things highlighted. This is the big benefit of being in a trading house, that you've got a Reuters screen. You can have certain aspects highlighted. So highlight 60. If that's a possible move that they could drop the monthly amount to 60, have that highlighted. If you see that green marker come up, that's your opportunity to sell. And we saw it, there you go. They dropped it to 60 billion. And they also did this until December. So we know that it's going to be for 9 months. We also then got the next comment that they are going to change some of the parameters of the asset purchase program. That they didn't actually tell you exactly what they were going to do, but it again indicated that something else was coming. And if this was a change of parameter, then again, this could also be bad news for bonds. However, the big takeaway was the 60 billion. Now, the initial move went the way you would think in terms of they're cutting the amount being purchased. However, think about it, and this is what got the markets to completely turn around, because 60 for 9 months is in fact more QE than 80 for 6 months. So they're actually continuing the purchases, they're actually continuing moving up the purchases, and this is what Mario Draghi kept banging on about in the press conference. He kept stating this is not a taper, because taper implies that they will continue cutting until there is none left. Mario Draghi also went on to say that if conditions become less favourable, then this alteration can change, and they can once again increase the amount of bonds that they purchase. So very clearly this is not a taper. However, the market does move very quickly on it, and this is where the instant reaction is often the biggest. That's where you get paid, and then you can really think through what's going on afterwards. Now, the change in the parameters was to buy maturities below 1 year and also below the depot rate. So this, he also stated, was if necessary. So it wasn't quite as clear cut as we would have thought, and actually had a slightly limited result, although it did make the Schatz turn around faster than the Bunds. So let's go and have a look at that video once again, and we'll see exactly how we can trade it now, knowing what we know. Okay guys, a couple of key things to be thinking about before we start the video. The taper, or perceived taper, was 60 billion. So the initial reaction we're expecting is a move down in the Bunds, a move up in the euro. Note where we're starting as well. 161.13 for the Bunds, around about 108.00 in the euro. And what this helps you do is think about how far it's likely to go. Previously, we do know that the Bund's been going about 70-80 ticks on an initial reaction, and we are expecting some quite aggressive turnaround and pullbacks in the Bund. So we'll play the video now and see how it all reacts. You start seeing the market really thinning out at the minute. This is coming into the last 5 seconds before the decision. We actually get a little skip up in the Bund, and then bang, there's the decision. We've got 100 lots in over the first 10 ticks, and very quickly start getting something out.
So we're 25 out for about 30 ticks. This is paid for the trade now. Now we're thinking about how far can it go. 60 ticks down already, got half the position out. Added a little bit more to see if we can get that final push. But again, we're now down 80 ticks. This is pushing the limit now of how far we can go. Get down to 20s, 90 ticks down. This really is pushing it. We're long the euro. And what you get is you get this final flush in the bund. There you go, down from 20s to 90s. So remember that we flushed from about 20s. That stops going off. That is often indicative of the end of a short-term move. So you now need to be thinking about getting out. We're down to 16 lots now. Starting to see there's 500s coming as well. What's happening here is people are realizing that actually the bond buying is going on for longer. So in fact, there is actually more QE going ahead rather than less. So it's not so much of a taper. And this is why you see this quick move up in the bund. One last chance of having a go at selling it. We come down, push through those 500, quick splash down, but look where we stop, right at where those stops went off again. And then the market starts getting bought back up. The 500s come in. People really do want this now. In the end, we see the bund actually close higher on the day. This is the advantage you're getting in very aggressively as well early on. The euro is now going offside, but the fact that we took 50 lots for about 20 ticks means that this 6 lot offside isn't so painful. So be aggressive, be committed to these trades very early on, get in, take your profit, and then try and run something.
Let's move on to the Fed now. And again, this is going to be the run-up to the December meeting from the Fed where they hiked rates. The Fed, like the ECB, does like to use a tagline, but they will also use dots and SEPs. I'll get onto what those are in due course. But the idea is the Fed likes to use a tagline. They do have a press conference, but the actual statement comes out in a screen dump. So what I mean by that is you get that Reuters box and you'll get all of the headlines all at once. So it is quite difficult to work your way through the headlines because you're trying to look for a tagline rather than, say, a number with the ECB. It is that little bit more difficult. However, this is what happened with the Fed. They like to use a tagline talking about near-term risks. So this back in July, we saw the initial start that they could be looking to do something. They have diminished. However, the stance of monetary policy does remain accommodative. So they are acknowledging that there's certainly no need to be cutting rates anytime soon, but they've also stating that it's accommodative and they have just diminished. Come September, they're feeling a little bit more hawkish, and so near-term risks are now roughly balanced. And they have started to consider when they're going to hike rates. The case for an increase has strengthened. So they're acknowledging that clearly the next move is going to be up. It is just a case of timing as to when that's going to be. Now, the Fed does generally do any kind of policy change on the meetings that have a press conference. This gives Janet Yellen the chance to explain herself and explain the reasons behind these moves. So they didn't do it in September. This was one with a press conference, so a possibility, but they've said that the case has strengthened. Come October, this is where they continue, stating that near-term risks are roughly balanced, and they have continued to say that the case for Fed funds rate has continued to strengthen. So they're building this up. It's continued to strengthen. You're now thinking, what more can they do apart from hike rates? And we do finally get it. They maintain roughly balanced at this meeting, which was seen as a little bit dovish. The expectation would be that they would drop roughly and just call rates balanced. However, the near-term risks are still maintained as roughly balanced. They've hiked rates from a half to 3/4, they've hiked the range from a quarter to a half to 3/4. So it's a 25 basis point increase. You remember that the Fed funds is a range. and gone back to monetary policy remains accommodative, indicating that it's unlikely to be too much from the near future. However, we have the dots. Now, what are the dots? Dots are an assessment by each member of the Fed as to where they see rates at the end of each year. Now, I've got a dot plot here. What it shows you is each dot is one member's vote. It obviously provides an anonymity as to where the members are actually seeing rates, but it gives you a median of where they expect rates to be come the end of 2017. So the median was moved higher in December to between 1.25 and 1.5, which implies 3 rate hikes before the end of next year. So this was beyond the expectations. Expectations were only for 2. They thought that the hike would come and maintain the rates the same as it was in September. However, they increased. It also increased for 2018, 19 as well. Longer term, it was the same as September. So this was where the hawkish slant came. The dots gave the indication. Now, dots have been wrong in the past. In 2015, the dots were indicating 4 hikes. In 2016, we got the 1 in December. So going forward, we can now start thinking about, are they going to start changing these dots? The expectation now is that we're likely to see a hike potentially in March, if not certainly in June. So it's now going to be a case of anything they do could end up starting to look quite dovish because they've set themselves this goal of 3 hikes in the year. Now, moving on to the SEPs, the expectation for these was all pretty much in line. SEPs are very similar to the dots in that they are the consensus view of the board members as to where GDP, inflation and unemployment are going to be come the end of each of the subsequent years. So we didn't see a great deal. We saw a slight tick up in GDP and a slight tick down in unemployment from what was expected, and that was it. So the key crux of the December meeting was the hawkish dots, the increase to 3 rate hikes within a year. The fact that they hiked rates was entirely expected. So that's where your trade was. Your trade was on the unexpected, on the increase of those dots. So let's go and have a quick look at a video of that, and we'll see again how getting in very quickly on the dots on this bit here, and again, this is why having things highlighted is very important. They upped it to 1.375. The expectation would have been for 1.125. So having 1.375 highlighted gives you the opportunity. The moment you see that is the opportunity to sell, and you would be, excuse me, you would be set to sell T-notes as well as euro-dollar. Sell euro-dollar because the dollar will strengthen as that drops. So that's the trade, that's what you're looking for. And then, as I said, that was in the statement. This is how you get the statement. You get that roughly balanced phrasing coming straight out early on, and inflation has increased, but they see only gradual rate rises for the rest of the year. So that's how the statement comes out in this screen dump type. So trying to pick out the individual phrases from it can be quite difficult. This is why the dots are very well watched. So let's go and have a look at that video.
We'll have a look at the charts. This tells you where the opportunities are. Structure, as I've said in previous videos, is very important. So looking at T-note on the left, you've got a well-defined trend line. The T-note has been coming off a little bit recently. You can see that in the chart. So what you're looking for is any break of this trend. You're looking down for the first level that comes in, quite noticeable there at 123.26.5. So that's going to be your first target. That's where you expect a little bit of buying on a first dip. And then beyond that, you're looking down towards 123.16, that lowest low you can see on the left-hand side of the chart. This is an hourly chart, so obviously this is showing it does take quite a long time to do the moves, but it is a sustained move over a bit of time. This is where getting in aggressively means that you can hold something and try and run it for a longer period. Looking over at the euro against the dollar, you've got quite a nice flag built up there from that move down from 108.50s down towards 105.27.5. We then see the bounce hold very nicely at 06.70 as well. So the break of that flag comes in at 06.30. You're then looking again like the T-note for a first move down to 105.71, that 105.70s area, and then the low coming in at 105.27. So be aware of those levels as it starts coming off. You'll see them in the video as well, and that's where understanding structure as well as where the first areas that people may or may not wish to take a bit of profit, that's where that is so very important. So let's go and have a look at the video. Okay guys, two ladders you're looking for. On the left, the euro against the dollar, and then one in from that, the T-note. Remember those levels we spoke about, 123.26 in the T-note, as well as 105.70s in the euro, and also that flag break in the euro comes in around about 106.30. So keep those in mind, watch for the reaction when we get there. Now remember, we've already got the screen dump, so as long as you've got your highlighting right, you'll be able to see those 3 hikes showing up before the squawk does. That's what gets us in early, and then we'll show you what happens when the squawk gets hold of it as well. Right, so here we go. See, the markets are looking very thin, and there we go, they've moved down.
The Fed
Get short as we see that information come out. You did see a quick skip up as well, and then that 1,000 comes in on the T-note. Notice we got in on the flag break as well.
Long-term federal funds rate to 3% from 2.9%. They raise the target interest rate to
covering a little bit.
Basis points. They see 3 hikes in 2017.
3 hikes. Watch the increase in the T-note in size here.
Fed expects economic conditions
add into the position because you've heard those 3 hikes. You know that other people have now got the information, and we start to come off a bit further. But where we're getting down to those 23, 26 areas, and you start seeing this bounce, the 700 comes in to cover a little bit. So we start struggling around there.
So again,
do get a little bit of a push through, but again we are starting to struggle. Notice the euro's got into those 105.70s, and again that's starting to struggle. You're seeing this, you know, quick profit take, and that's what's giving us that little bit of a bounce in both markets. However, we've got in quick, we've covered quite a lot very early, and this is giving us the opportunity to run a smaller size move. Like we've got 3 lot, 2 lot in the euro, and then we're down to about 20 odd in the T-note. So that's where getting in very quick gives you that opportunity to hold on for a little bit, wait and see if you can get that continuation of a move.
Bank of England is slightly different from the ECB and the Fed, and when you're trading the Bank of England, it is more akin to trading a figure. So if you think about what we talked about in day 5, the actual figures of how far out of line it's going to be, what you expect the market to do on it, and then how you're going to execute, as opposed to the actual wording. The wording does seem to change. There's no consistent tagline with the Bank of England. So what you're really looking for is the vote if the rates aren't subject to change. If the rates are subject to change, then obviously you're going rates first. That's going to be the key one. And then you're looking at the vote. So for the last year or so, the vote has actually been 9-0. Anything, if you see a vote come out anytime soon that is 8-1, that is likely to be a hawkish vote, and gives you a trade. So that's the kind of thing you're looking for. Obviously, it becomes a bigger trade, a bit like a figure coming further out of range if you get a 7-2. So that's the area that you're really looking for. It's on the rates, the asset purchases, and then the vote. That's the key thing. They do like to put in some kind of forward guidance. At the moment, they're using the phrase either direction for rates. So they could be up, could be down. They have also stated in the past that rates have no lower bound. They do have a lower bound, and this will not go below 0. So they're quite clear on how rates can move, but they have stated either direction. This will potentially give a trade in the future on whether they drop either. If they drop either, knowing that they can't go below 0 and rates are currently at 0.25, this would imply that chances are the next move is likely to be a hike. Mark Carney, the head of the Bank of England, has also used this phrase in the past, that the next move is more likely to be a hike. So they will guide you in that sense, but it is more like trading a figure, which is why I'm not going to continue to go into too much more detail on the Bank of England. It is more meeting by meeting approach, and trade the actual result, the figure as it comes out. So outside of central bank meetings, how else can you make some money trading central banks? It all comes down to comments and sources. Now, central bankers will periodically appear at press conferences and give speeches. They can use these to guide monetary policy. If they feel that monetary policy has not sufficiently been understood by the markets, they will use these times to guide the policy. Mario Draghi has done this very well in the past, and the main one was in 2014, where he said we will do whatever is necessary, and this was the first sort of stirrings of QE coming up. So key thing is you need to know the members. You need to know the main members. You also need to know whether they're hawkish or dovish. If they're hawkish, they're more likely to be looking for a rate hike and a pulling back of QE. If they're dovish, then they're more likely to want a little bit more of it. So someone who speaks very often is Jens Weidmann. He is the head of the Bundesbank in Germany. He is very hawkish. So what this tells you is if you get a comment from him saying the ECB should step back on QE, well, that's probably his stance anyway. He's never been that comfortable with the asset purchases from the ECB, so it's nothing new. It's when you get the opposite come out, if he says something like we can see reason for further QE, or that the recent reduction in asset purchases was not warranted, then that is extremely dovish. So it is all about knowing your members. Also know when they're speaking. If they've got a press conference coming up, if you know they're speaking somewhere, then make sure you're ready for it. It is like a figure. It will not always produce something, much like a figure as well, but be ready, be waiting, just in case they do something a little bit different and try and influence the market. Now, sources predominantly come from the ECB. You get ECB sources. Now, it is not clear who gives these sources. Apparently, the information is leaked. My suspicion would be that it is intentionally leaked to guide the market. The sources are generally right in what they say, and so this is where you get a big opportunity. But they are ad hoc. You don't know what they're going to say or when they're going to say it. We'll come on to that in a moment. Again, moving on to the FOMC and the ECB. Very similar thing. Understand their leaning. Also understand who's coming in, who's going to be voting. As you can see, in 2018, the Fed, or in fact in 2017, this year, the Fed has got a lot of dovish members. So despite the fact that they have indicated 3 rate hikes for 2017, there's only one hawkish member in Patrick Harker. So pushing this through could be a little bit more difficult. However, once you get to 2018, you've got a lot more neutral to hawkish members, which could tip the balance. Obviously, the main 8 will always be there, or sorry, the main 6 will always be there. But watch out for how the rotation is coming. That is very key. Also, going back to the ECB, when they brought in corporate bonds was notably a meeting when Jens Weidmann was not a voting member on the ECB. So that's the hawkish dovish spectrum. Be very, very aware of that and know who is on the councils at any one time. Now, here's an example of sources, and this is where you've just got to be aware. There's not going to be a time, you don't know when they're going to come out. Now, the ECB sources came out stating that the ECB seeks to lend out more bonds to avert a market freeze. You don't have to understand all the implications. This is to do with the repo markets and the tightness in repo markets. The ECB is seeking to alleviate this by lending more bonds. So, how does this work? What you've got to be thinking to yourself, lending more bonds means more bonds in supply, means selling of bonds. This is what you get in the Bund. You get a very quick move of about 70 ticks. Again, this is as big as a monetary policy meeting in some cases, and this was massive for the Bund. Understand the moves. What you've got to understand is they're lending out more. This implies selling in bond markets. It is also talking about changes to what they will accept as a collateral, which means if they're going to accept new types of collateral, you don't necessarily need the bonds that normally would be in demand to use as collateral in repo operations. So again, this is further weight into the bond markets. So just understanding that, you can't necessarily prepare for it because you won't be able to have thought of a scenario for all of these things. But as soon as you hear it, you've then got to start thinking, right, what's the market going to do? What's the implication? How far can this go? And as you can see there, it's a good 70-tick move in the Bund. So if you were quick on it, assimilate that information very quickly and execute. Be confident in your decisions. These are some of the trickier ones because not everyone in the market will have it immediately. You've got to be very confident in your position, very confident that you are in the right trade, but let it go. Worst comes to worst, if you're getting in around here, put a stop in and accept the loss. It's going to be a pretty small risk reward. Yes, ultimately, you will do these trades with more size. So if you do get stopped out, it will be a little bit more expensive. But look at the risk reward on the trade. Think about it in that sense, that these are the ones where if it goes, it does go, it breaks levels, you get a big flush. That's when you get out on the flush. So keep that in mind when you get sources comments. Don't just jump out if it starts to pull back a little bit. Be confident in your analysis, stick to your trades, and that's where you get paid on these moves.